Many of you have asked me about my opinion on SPGI, which is S&P Global. This is one of the best business models in the history of the world. They have the S&P 500 index. They have the Dow Jones Industrial Average, which we all know trillions and trillions of dollars are benchmarked on the S&P 500. They have the credit rating business alongside Moody's. They pretty much have a duopoly in terms of rating bonds and credit rating on debt in general. And even the 2008 financial crisis could not destroy this company. So they have one of the best moats, one of the best business models in the world. The stock is down 9% over the last 5 days and around 10% on the months. And it's not usual for SPGI, and it's getting interesting. So many of you have asked me about my opinion, if I believe the stock is like a generational buying opportunity, or if I believe it's still overvalued. So I'm going to let you know my opinion. And I really hope you enjoy it as always. Now, SPGI makes money from 5 different segments, and I'm going to go through each one of them and let you know what I think about it. And the first one, which I believe is really the best one amongst SPGI, is really the S&P Dow Jones indices. When you have $20 trillion in assets indexed or benchmarked to the S&P 500. $27.7 trillion in assets indexed or benchmarked to all S&P 500 Dow Jones indices. So they have the S&P 500, small cap, mid cap, Dow Jones, the TSX, which is a Canadian index, ASX, which I believe is the Australian index. And this is, again, they have a monopoly on that. And this is mainly a bet on passive investing. So passive investment, retirement accounts, they've been increasing more and more over time, especially now as the U.S. government has put up $1,000 for each child, where I believe it would be invested in an S&P 500 index fund. And this business for SPGI has around a 70% operating margin. So this is their highest margin business, and they make a ton of money from that business, and it's really, really amazing. The second part of their business is the credit rating. The credit rating is what I believe the second best one in terms of their business, and even the financial crisis, which they were largely responsible for. If you watch the Big Short movie or if you read the book, S&P and Moody's, they kind of gave a little bit of inflated credit ratings. They gave AAAs when they should not have been giving AAAs and AAs to a lot of the bonds and a lot of the credit instruments that they had back then, the mortgage-backed securities and other kind of things. And they made big mistakes, but even 2008 could not destroy the company. And again, they have pretty much a monopoly, where I believe S&P Global has 35% of the market, then Moody's has 35%, then Fitch has 10%, and you have other agencies which have 2-3% each. So they pretty much have a monopoly or duopoly alongside Moody's. And this is a business that's always going to exist because you always have new debt, new issuances, and they have to put up rating on the debt. Even on US government debt, they have to put ratings on it, and they have to upgrade it and downgrade it. And again, it's just an amazing business model. It's always going to be here. This is a business model that has high barriers to entry, and this is something that you cannot destroy it. And this is only going to get better if we have lower interest rates. You're going to have more debt issuance, which is going to benefit SPGI in a major way. And this business for SPGI generates about a 63% operating margin. So this is the second highest operating margin business. Amazing stuff. The third business of SPGI is their market intelligence, which I believe they have certain data, they sell data. And this is 96% recurring revenue. And from this business, they generate around 33% operating margin. Again, pretty amazing. Another business they have is the commodity insights, where they sell, I believe, commodity benchmarks on even gold and copper and other kind of commodities. And most of it is, again, subscription-based revenue. Not a huge part of the business, but a good part of the business. And this one generates a 47% operating margin. So this is, again, a very high margin business. Now, the last one, which I believe is the third best business segment amongst SPGI, is their global mobility, which they acquired Carfax not long ago. Now, if you're familiar with Carfax in the United States, they have 46 million users, 35 billion vehicle history records. And normally, whenever you have to go to buy a car or finance a car in general, you normally look at the Carfax report to know if the car has been through an accident, it has been totaled, if something major has happened to it. So if you want to look at the car's history, you have to get a Carfax report. Just kind of you get a FICO report to know if you're approved for a loan. You kind of get a Carfax report on the car you want to buy to know if it's good, if it has been damaged, what kind of history it has, if it had any major accidents, major damages before you buy it. And they pretty much have a monopoly in this area. I have really never seen any dealer use something other than Carfax, unless I'm living under a rock. But I've seen all of them use Carfax, and this is an amazing business for the company S&P Global. And in terms of mobility, it has, I believe, around a 39.5% operating margin. So this is an amazing, amazing business for the company. Now, if you say, if this company is such an amazing company, then why is the stock going down 10% on the months? Well, there's many different reasons. One of them had to do with valuations. The stock was kind of priced to perfection, and revenue growth has kind of peaked since September of 2024. It went from 16%, 14%, 8%, 5.8%, 5.3%. So revenue growth has massively decelerated on the company. And, the multiple is trying to keep up with that. It was a little bit extended. It's still extended, I believe, but it's getting a little bit better. Another reason for the sell-off is they compete with a company called FactSet in certain data providing, and FactSet issued really bad guidance, and this has affected S&P Global a little bit, and Carfax, which FactSet, which I'm not a big fan of, is down 40% on the year, and again, I don't like the stock too much. S&P Global is way better, but this is two reasons why the stock has been going down, and it's again mainly the valuation. The stock was trading around 30, 31 times earnings, which, yes, it's a high quality company, but for such slow revenue growth, declining revenue growth, it was just too expensive, and the market is catching up to that, and it's now trading at 28 times earnings. Now, the average is 29.5 times earnings, and the company deserves a premium because of the moat, because of the competitive advantage, because of the high margins. I mean, you have the credit rating business, you cannot destroy it. You have Carfax, which is number one in looking up car history, and then you have the S&P 500 index and the Dow Jones and the TSX and the ASX indices. I mean, this is irreplaceable stuff. So it does deserve a premium. It was too much of a premium. Now it's at 28 times earnings, and I believe it's still a little bit extended. Now, assuming no multiple expansion and no multiple contraction, assuming it stays at the same multiple, and SPGI grows earnings around 11 to 12%, which has been growing around that on average. Now, this is GAAP earnings. This year it shows 40%. It wasn't 40%, it was much lower, but they had some one-time expenses, and I adjusted for them, which doesn't show up in this graph, but it's around 11 to 12% on average. And if SPGI grows 12%, let's say in earnings per share, and have a 1% dividend, this is 13%. Assuming no multiple expansion or contraction, I would expect around a 12 to 13% annual return on SPGI from here. Now, I'm going to be honest with you guys. I think SPGI here is really not bad relative to its moat, relative to its earnings per share growth, and relative to its net profit margins of around 29.5%, very high net income margins. But I have another stock which I believe is kind of much, much better. Now, maybe it's not the best comparison because SPGI is more diversified. You could maybe argue it has a better moat. You could maybe say that. But this is another stock where I look at it. For me, I own the stock, and I think it's a little bit better than SPGI. And I'm like, SPGI relative to this stock is overvalued. And for me, if I want to buy SPGI, it would have to be at a much lower price. And I'm going to give you the comparison and then give you my buy price on SPGI. But the stock is Visa. Now, if you compare Visa and SPGI, they're trading at the same multiple. Now, Visa also has kind of a duopoly with MasterCard. Visa is an amazing, amazing business model, very high margin stuff. It's a bet on inflation. If prices increase 11%, if Visa is going to get an 11% increase without having to raise prices, it's automatically indexed to inflation, has little to no competition, maybe paying online with crypto or whatever, maybe now is becoming more popular. but in stores and other places and all around the world, they're still using Visas and MasterCards, and the usage is increasing. So now Visa and SPGI, they're trading at the same multiple. If you look at net profit margins, SPGI is 27%, or I should say 29% as of the last quarter. Visa is 52% net income margin. So you're getting double the net income margin with Visa versus SPGI. And if you look at Visa's earnings per share growth, it has been 12 to 13%. So you're getting higher margins, pretty much the same earnings per share growth for the same multiple. And for me, it's a little bit of a better business. So when I look at Visa, I'm like, Visa is much better than SPGI. So why would I buy SPGI? And for me, SPGI, I would be getting interested under $400 per share. My fair value for a while has been under $400, so $400 or below. The multiple would be closer to 25 times, 24 times, and the stock has a history of kind of bottoming out, as you could see here, 25, 24. That would be around $400 per share or below. I could potentially be a buyer of SPGI, but as I own Visa, and I believe both of them are like high quality companies with wide moat, I mean, if I had to choose, I would choose Visa any day, to be honest. And for me to buy SPGI, it would have to be a little bit lower. So I think the valuation is still extended, and I'm waiting for a better price. Hopefully 25, 24 times would be interesting. If not, then I'm fine. And I'm a patient investor, so I can wait more, or I can maybe find another one. And that's my opinion on SPGI, not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.